This is the current federal tax developments for the week of September the 11th, 2017. Current federal tax developments is brought to you by the Loscalzo Institute, a Kaplan company, and by your state society of CPAs. This week we have a few developments to look at. We're going to take a look at the IRS Memorandum that discussed the application of the plan loan grace period provisions. We have a discussion about a case for a taxpayer whose loss the court found did not qualify for the special relief that we got during the Madoff scandal. We have a third issue where the IRS gives us a notice that will allow employees to donate leave time if the employer pays that out for Harvey relief. And finally, we'll look at the IRS memorandum discussing the case of an S corporation that used a professional employer organization, and did that convert the case to a worker classification issue when the IRS attempted to argue that the S corporation officers had not taken adequate salaries through the PEO, and that a proportion, I should say, of their distributions from the S corporation were salary. Well, we have a few things coming up here for courses and want to mention those coming up before the October 15th date that we're all going to have a little bit of fun with. New York City, again, we have two courses coming up on the 28th and 29th of September, put on by the New York State Society of CPAs at their offices. On the 28th, current federal tax developments. On the 29th, real estate partnerships, get in, get out, and get taxed. Don Cochran will be presenting those. That will be both in person and webcast. You can register for that at the New York State Society of CPAs website at cpe.nysscpa.org. I also am going to be doing some courses on September the 27th and 28th in Fairfield, Ohio. Again, remember, I'm doing the alternative minimum tax course in the morning on the 27th in Fairfield, and the passive activities course in the afternoon on the 27th. And on the 28th, we're going to do a full day course on multi-state taxation of business. Don also has a course coming up on October the 4th and 5th. He'll be in Rapid City, South Dakota. So if you haven't been up there and seen Mount Rushmore, you can go there and pick up courses. On the 4th, Don will be doing a session for assisting the survivors of a decedent's estate. And on the 5th, he'll be doing a course on multi-state taxation of businesses. You can register for those courses at www.sdcpa.org. Now, again, only the New York City courses are currently offered as a webcast option. The other two, the ones in the Cincinnati area in Fairfield, Ohio, and the ones in Rapid City, South Dakota, those you have to make it to the building in order to take the courses, but we look forward to seeing you for one of those. Now, coming up, let's talk about the first case we're going to talk about today, and actually this is a Chief Counsel memorandum. It deals with a question of the grace period in qualified plan loans. For whatever reason, topics tend to run in streaks, as you may notice when we have these in this area of tax updates. And this summer, apparently, the grace period for plan loans became the topic of the summer. And this is the latest in Chief Counsel Memorandum 2017-36022 that was issued on September the 8th of 2017. This is a case of looking at, apparently, somewhere in the IRS, a question arose. It could have been on an exam or something similar, about how the grace period rule should be applied for plan loans. Now, as you may be aware, some but not all qualified retirement plans can offer loans to participants. We discussed that last week. We're talking about Harvey relief and the special rules for Harvey relief loans from plans. So plans like profit sharing plans can offer loans to participants. Pension plans generally can't. If the plan offers a loan, it has to meet certain requirements, because if it doesn't meet those requirements, the loan is immediately considered to be a distribution. One of those requirements is that the loan can be for no more than 5 years. It must have a level amortization. You can't have an interest-only loan with a balloon at the back end. And the payments must be at least quarterly. If a participant fails to comply with the terms of the loan, generally the rule is, well, that's now a disqualified loan and we have a distribution. But the regulations allow recognizing that minor foot faults shouldn't necessarily create major problems. They allow a plan to include a provision that allows for a grace period to solve a problem if there's a missed payment. The grace period generally says that if a payment is missed, you have until the end of the following calendar quarter. So basically, if you miss a payment here in September of 2017, that puts you in the third quarter of 2017. So September 30 is when the quarter is going to end. You have to correct the error by December 31st. But if in fact you correct the problem by December 31st, you make up the missed payment, you make the missed payment by December 31st, then all is well. Well, now we got to ask a question. How does that apply in the real world? Because in the real world, things aren't going to be nice and simple. It's not necessarily going to be that somebody missed a payment on September the 10th and got it into you on September the 11th. You may have things a little messier. And so Chief Counsel Memorandum 2017-36022 takes a look at two situations. The first situation it looks at is going to look at what we'll call shifting payments. And here's the fact pattern they gave. A participant makes timely installment payments from January 31st of 2018 through February 28th of 2019. And apparently this person is making monthly payments. They missed their March 31st, 2019 payment and April 30th, 2019 payments. Okay, so we have two separate issues where we have a missed payment. So our grace periods there, generally, let's see, March 31st, that's in the first quarter. Our grace period to fix that is going to be June 30th of 2019. And then the April 30th payment, well, that's in the second quarter. So our grace period for that's going to be September 30, 2019. Fine. That part's pretty simple, but let's talk about what really happens because this is the real world. The participant misses two payments, but makes the payments on May 31st and on June 30th. Now, the May 31st payment, the plan applies to the March 31st installment payment. And the June 30 payment is applied to the April 30. Now, of course, the problem is we have two new missed dates, right? On July 31st, they make the payment and then they make a triple payment on July 31st, making up all of it. Now, the question becomes, is this acceptable? We went into default in April and we remained in default at the end of June. Is that a problem? Because that was our fixed date. And the answer from the IRS is that's not a problem. The April missed payment was made up in May. When we got the first, or I should say the March missed payment, which is where our first problem was made up in May. Right? Now we have a May missed payment, but that again, we have till September 30 to fix because that's in the second quarter. We, of course, fixed our second missed payment with the next payment, but then we made a triple payment in July 31st. That fixed it. So we didn't have a problem. The fact that we were in default at the end of March and we still were in default at the end of June, it's not considered the same default. So you do not have to treat that as a distribution to the employee. It was cured within the proper period. They went on and looked at a second situation. This one's a little more interesting. This looks at a refinancing. In this case, a participant made their timely payments from January 31st through September 30. They missed their October 31st, November 30, and December 31st payments, going for the trifecta. So now they have till March 31st of 2020 to fix the problem. On January 15th of 2020, they refinanced the loan and replaced it with a new loan equal to the outstanding balance of the old loan, including those three missed payments. And now, of course, they have to repay it in equal monthly payments through the end of the replaced loan's payment term, which will be in December of 2022. Now here's the question. They've not made a payment. They never did fix the first loan. They just refinanced it. Is that okay? Well, the IRS concludes in the memo that that's also just fine. In essence, the refinancing is a new loan that paid off the missing installment payments. And now the only question is, are they going to comply with the new loan? Well, that's interesting. It may surprise some people that the IRS would have viewed it that way. Now, there is one very practical problem here. Remember, plan loans, we have a maximum, right? And ultimately, no matter what your balance is, at the most you could ever borrow from the plan is $50,000. And we have a 1-year look back rule that reduces how much you can borrow. So the maximum loan I can take out today from the plan, let's assume that I have a vested balance that's 300 grand, so I don't have any problem with the percentages. So I can take the 50 grand loan, the max loan. But I can take 50 grand less the maximum balance of all loans outstanding from that plan in the year prior to the date I'm going to try to take out this loan. So what that means from a practical standpoint is I could solve this problem if my refinance loan is going to be less than 25,000 and I was at less than, and I was always at less than 25,000, my max balance 1 year previous has to be, after you take 50,000 minus that, that's got to be how much I'm going to refinance. I can refinance no more than that without triggering the problem of taking too large a loan. So this refinancing option, while it looks interesting, I have a feeling in many cases you're going to discover it's going to be tripped up by that they don't have enough borrowing capacity for the refinancing to solve their problem. But it's interesting the service looked at it that way. And obviously, if you have that situation and you're administering a plan, you want to make sure you've looked at these rules and looked at the IRS's views on how you should be administering those loans and what you can and can't allow a participant to do without having to issue them the 1099-R. Next up, we're going to take a look at a case of a taxpayer who fell for a too good to be true investment. This is the case of Hamilton versus United States. The case was heard in the U.S. District Court of the Northern District of Indiana. It is case number 1:15CV00303. The opinion came down on April the 5th. Now, the taxpayer, as I said, fell for a too good to be true investment opportunity. At least you would think somebody should have figured this out. He was told, well, we're developers, right? Okay, so he's approached by these developers, or at least claimed to be developers. They said, look, we want to finance our new project. So what we want you to do is, well, how we're going to do this is you're going to buy a lot, a 10-acre lot from the developers for $500,000. You're going to get a loan from the bank to buy it from us. And then, of course, you're going to, give us that money. You're going to put some small amount down, borrow the rest. We agree a year from the day you sell it to us, we will buy it back from you. You paid us $500,000. We'll buy it back from you for $625,000. Now, that's an amazing level of return, right? Just think about that. This is a 25% interest rate that they're going to pay us effectively, because what we're really doing is using our borrowing capacity, and they agree to pay us back at 25%. So it's, well, this is a can't lose proposition, right? Well, obviously only if we get bought back, but the developers told us, hey, we're worth $100 million. So there's no risk. Now, I think a lot of you probably have a lot of alarm bells going off when you hear this, because the obvious problem, as the court pointed out, is it's unclear how you explain the developer's willingness to pay a 25% interest rate if they had such substantial assets to offer as security. Why couldn't they get a loan for much less expensive than paying these huge rates to have these people stand in for them and borrow? A lot of us would suspect the real answer there is they're probably not really, though those assets aren't really as unencumbered as they're suggesting, and they have no borrowing capacity. That's why they need you to borrow for them. And oh, by the way, considering that problem, what's the chance they're really going to go ahead and do the development? Turned out all the answers turned out to be bad. Year later came, the property was not bought back from them. Developers couldn't be found. Developers, were unable to buy it back, so they didn't. The developers also had never done anything on this lot. The individual lots, because again, they had a whole bunch of individual lots that they claimed they're going to make this big development on. The individual lot by itself was basically worthless. If it wasn't developed, it'd never be worth anything. So you didn't have the other developments to go around with it. So now the taxpayers are stuck with this piece of land and a mortgage on it, a piece of land that's not worth a whole lot, and a close to $500,000 mortgage on the land. Well, the state came in and shut this program down. But, so they said, well, we really here got taken, right? This is a scam. And they said, you know what? We think this is kind of like the Madoff scam. So they tried to claim relief under Revenue Procedure 2009-20. You may remember 2009-20 was meant to get around a problem. Generally, you cannot claim a loss deduction as long as there is a reasonable prospect of recovery. So normally, if you're actually pursuing collection, you're trying to get money back, and they were suing the parties at this point, you're not going to be able to claim a loss until such times as you've determined there's no reasonable prospect for recovery. But in the Madoff case, because the Madoff investors were suing third parties, many of them, so they couldn't show there was no reasonable prospect of recovery, depending upon how those lawsuits went. But under the rules that came in Revenue Procedure 2009-20, those investors were allowed to claim a deduction, and it kind of depended upon how much, whether they were pursuing collection or not. For the Madoff losses, for the year we discovered that the Madoff thing wasn't really what it said it was claimed to be, they could claim 75% of their loss if they were pursuing collection from third parties, and 95% if they're not seeking recovery, and the remainder would be trued up when in the end we discovered if they really did recover anything, either from Madoff securities or from the third parties. But in order to be able to use Revenue Procedure 2009-20, one of the requirements is the lead figure has to be indicted. Well, it was criminal conspiracy. Remember, Bernie Madoff was criminally charged. The catch in this case, while the state was going after these people, while they were filing civil suits, they never were charged criminally. And that's a problem. Well, they went back and said, hey, no, not really totally, because the IRS came back a couple of years later, Revenue Procedure 2011-58, and modified it and said, well, civil proceedings can be the trigger for the deduction in certain cases. Now, this actually arose largely, many of us in Arizona are quite aware of how that one arose. It arose from a case of a program in Arizona where when it was discovered that it wasn't, things were going to fall apart, it wasn't going to work, the lead figure committed suicide. Obviously, we can't indict this person now, supposedly. So if there was fraud or other issues, this person can't be indicted. So the IRS published Revenue Procedure 2011-58 that said, okay, if the lead figure who would have been indictable, who could have been indictable, if there had been a criminal investigation, there's not going to be any at this point. If that person has died, you can use the civil actions against the entity as evidence of the wrongdoing that allows you to take the deduction. Well, they tried to claim that in this case, but the court pointed out that one of the requirements under that ruling is the lead figure died. And guess what? Lead figures here were very much alive. So they were available for criminal prosecution if it was discovered they had done something criminal. Because of that, now, by the way, this is a really bad case because By the time we're to this, a number of years later, they're still trying to collect in lawsuits. They haven't gotten a penny. The taxpayers end up having to file bankruptcy because they've got this crushing debt and no real assets. No assets here. They lost all that money. So they got totally nailed in this thing. There's no way to say they didn't. But the bad news is, under the tax law, they're not going to get any deductions until there is no reasonable prospect of recovery can be shown. And that's probably going to take a number of more years. These programs don't move too fast. So remember, your timing for loss deductions, the Madoff situation was a special case. It's not the norm. Normally, you've got to show no reasonable prospect of recovery. If you have somebody who does have an investment loss, you test it to see if the Madoff rules could apply. But remember, unless the lead figure dies, you're going to need a criminal program, some criminal charge, in order to trigger the Madoff relief, which is still out there. But again, it's difficult to apply in a situation that's not Bernie Madoff. Next up, notice 2017-48. This is issued on September the 1st of 2017. This is continuing a relief for Harvey. And I'm actually recording this on Saturday morning. And as probably most of you are aware, and some of you probably listen to this after the incident has happened, at the time I'm recording this, we are looking at Hurricane Irma taking direct aim at Florida. So all this hurricane relief and all these provisions that we've heard about for the Houston area, it looks like, unfortunately, it's about to expand rather drastically into a number of areas in Florida. So keep your eye. Expect there to be a number of cross references that will expand Harvey relief to give us Irma relief as well. But for right now, of course, where I'm still recording prior to the date where we have anything happening there, but keep your eye on it. This gives us something which we first saw back in the Ebola case, where employees were allowed to make donations of leave time for Ebola relief. Remember Ebola? A number of years ago. Well, the IRS has brought that back. Notice 2017-48. Employees can donate, an employer can set up a program where the employees are allowed to donate their leave time. It can be various types of leave time. It could be vacation time, sick time, personal leave. Okay, those of you here in Arizona, be careful if you donate sick time. By the way, in some other states where there's mandated sick time, I would say that'd be risky to have employees donate sick time, because at least under Arizona's law and California's law and probably a whole bunch of other states' laws, that donated sick time, you might still have to let them take it. So I'd be careful with sick time, but the ruling would allow sick time if that works. You could donate that. In essence, I give up my, let's say, 30 hours of remaining leave for the year, and my employer then writes a check to for Harvey relief to a charitable organization providing Harvey relief. That's essentially 30 hours at my rate of pay. Now, the problem with that sounds great. The problem with that is, though, there's a real question for tax purposes of, isn't that really compensation to the employee, followed by a charitable contribution deduction, which may be bad if they don't itemize? Or secondly, is it maybe a contribution, charitable contribution by the employer, which, if that's like a C corporation, remember we have the percent of income limitation, that can make it very difficult to get a large benefit from charitable contribution. Well, this ruling seeks to sidestep both of those. For qualified programs, the IRS agrees it will not treat it as taxable compensation to the employee. That's good. So the employee does not pick that up as compensation, but it will still allow the employer to treat it as a compensation deduction rather than a charitable contribution. So it'll be a compensation deduction under 162, generally going to be fully deductible, no problem. That's a much nicer result than the alternative. Again, right now, this is limited to, at the time I record this is limited to Harvey relief. I would not be surprised that a week from now, we're talking about expanding this and the other relief programs to cover Hurricane Irma. At the time I record this, the only expansion we have so far for Irma deals with the U.S. Virgin Islands, because as of Saturday morning, that was basically the only U.S. entity, because Puerto Rico has their own taxing authority that's related to U.S., kind of tied in, but the Virgin Islands is done a little differently. It all gets kind of messy with territories and taxation. But that's the only thing we've gotten so far from the IRS. Expect, though, there's no question we're going to see this expanded into Florida. So, but just keep your eyes on it. Don't actually do anything until you see the notice, because nothing says it absolutely has to be expanded, but certainly we'd expect it to be expanded. Finally, we have here Chief Counsel Advice 2017-35021 issued on September the 1st. This deals with a case of an S corporation that used a professional employer organization. Now, a PEO, generally, what you do with a PEO is you essentially outsource your payroll function is effectively what you're doing. So your employees become officially employees of the PEO, and they're on the PEO's payroll. And then they do services for you. Now, you retain the right to fire, terminate, do all the normal things, but they're considered to be employees of PEO. So you don't issue any W-2s. Okay, all well and good. And the officers were in this. But now here's the problem. The IRS is apparently examining this S corporation, and they decided the shareholders had taken on a reasonably low salary. And, therefore, some of the distributions that were made to them represented disguised compensation, and they're going after the payroll taxes. The catch, of course, is for the years they didn't use a PEO, this is just simply an underreporting of wage income by the employer. That is, and the big key issue here is when the IRS assesses that tax for having underpaid payroll taxes on existing employees, we've already conceded these people are employees. Therefore, the tax court doesn't have jurisdiction. The tax court has jurisdiction to hear a question about whether somebody is an employee. But they don't have jurisdiction in a payroll tax case where the question is whether we had underreported the wages of the employee. That's one of those cases where your only choice is to pay the tax and sue for a refund. Obviously, we would prefer not to do that. We would much prefer to find some way. In most cases, the idea would be, I don't want to pay the tax. I want to go to tax court and, and fight this out there. Well, the question is, since they used a PEO, the S corporation did not issue a W-2 to these owners. And of course, we were now going to have it, the S corporation had paid the distribution. So we're going to go after the S corporation for the assessment. So is this now a worker classification case? The memorandum concludes that it did not convert it. It says nobody here is claiming these people aren't employees. The only question is how much salary they got. Merely putting a PEO in place in the middle doesn't change any fundamental fact in this situation. So because of that, it's not a worker classification case. Therefore, the IRS position is the taxpayer does not have a right to get the old, the whole 90-day letter and file in tax court to challenge this position. Rather, you got to pay up, guys, and then sue us. We'll see you in district court or the court of claims. That's the key issue. There's tax court jurisdiction issue. Well, as I say, we're coming up. Hey, by this time next week, you should all be done with your partnership and S corporation extensions. Now we're going to head down the 2-week run for trusts. And then we have the 2-week run for individuals. That's always, all this fun stuff here. But we're coming up on major CPE season. Be sure to go back and take a look at your state society's list of courses. The State Society offers lots of options during this time frame because we all know that we tend to like to get our continuing education from just after October 15th to right about the middle of December is really the prime period. And we have a lot of courses running in there. The state societies have that. Be sure to check that. Also want to remind you, we and virtually everybody else your state society works with are also available to do in-firm courses. So let's say you have a firm or maybe 2 or 3 firms, you get a group together that has an interest in a particular topic. You actually may find the math works well to to have one of us come out and give you the lesson in the topic. If you're interested in that, you can contact your state society or contact Loscalzo Associates directly, and we can put you in contact with the right people for doing that. But be sure, check your state society offerings and check to see what's coming up. This has been the Current Federal Tax Developments here for the week of September the 11th, 2017. You can catch your daily updates at currentfederaltaxdevelopments.com. That's where we'll give you updates as we post things during the week about developments that take place. Expect a lot of hurricane-related developments to come out this week. That's unfortunate. It's unfortunate the fact we have another hurricane, but expect those releases to come up. We'll try to keep you up to date on that as it happens. We'll also keep you up to date on anything else that goes on during the week. Supposedly, we should shortly be getting some more information about tax reform. So we'll see how all that works. Also, if you have any questions or comments, you can send them to me, Ed Zollers at currentfederaltaxdevelopments.com. And you can follow me on Twitter. There you'll find me. It's at Ed Zollers. So look forward to seeing you next week when we'll take a look to see what else has been happening here in the area of federal taxes.